Well, our next guest manages the largest block of money at the world's largest money manager. He is Dennis Stattman of BlackRock, where he oversees about $83 billion. Dennis, we've all been listening to the Fed, and I got to ask you right off the bat, what are they saying at the Fed, and how does that jibe with your view of the world?
Well, I don't think Mr. Bernanke said anything really new or newsworthy today. And the Fed continues to look at the economy as having deflationary risks rather than looking at the actual inflation that we've been experiencing. They've been very aggressive in easing policy, and it's helped asset prices from time to time, but it really hasn't fixed the employment situation we have.
In other words, it's been good for guys like you and for your investors, $83 billion under management, but it hasn't really fixed the fundamental problems. That's what you're saying.
No, it hasn't. And the fundamental problems really need a repricing of the labor market and some change in our tax system that favors domestic production rather than penalizing it.
And how do we do that?
I think we need very fundamental tax reform. Right now, products that are imported into the United States bypass our income tax system to a large degree, whereas domestic production is more heavily taxed. It hurts our cost competitiveness.
So we're disadvantaging ourselves?
Yes, we are.
Is a value-added tax one way around that?
Well, not if it is an addition to what we're doing today, but if it's a substitution for taxing income, I think that would be smart.
Christina Romer, formerly in the administration, now a professor at Stanford, had a very spunky, to say the least, editorial. You probably read it in the New York Times. She said, desperate times call for bold measures. Volcker understood this in 1979. Roosevelt understood it back in 1933. And this is Ben Bernanke's moment. He needs to seize it. So what does he need to do that he's not doing now?
I don't think there's a lot more that the Fed can do. People will come up with various tools from the toolbox that they can quote, but short-term interest rates are already zero. Long-term interest rates are very, very low. There's plenty of money available. It's simply that consumers and businesses don't have the confidence to spend it.
So if all he can really do at this point is another version of Operation Twist or QE3, throw more money at this thing, is that ultimately not even effective?
I don't think it's effective for economic growth particularly, but it's great for asset prices.
But would it really? I mean, QE1 worked, QE2 kind of worked. I don't, you know, would QE3 really have an impact, do you think?
Well, it depends on what it looks like, but if you gave me the choice as an asset owner as to whether to have QE3 or not, I'd say QE3 would benefit me as an asset owner.
All right, when we come back after the break, we are going to get into some of those assets. But before we go to break, I just want to ask you also about the EU. And you were with the World Bank in your previous incarnation years ago before you were running money. As someone who worked in the World Bank and now looking at the EU, what's your impression of what's happening over there?
It's very complicated because it's an attempt to deal with 17 different countries and fiscal policies with one monetary policy. And those 17 different countries have very different competitive positions, very different financial positions, and we're at a political impasse now where the less competitive countries have real problems with austerity, and the more competitive countries are asking, why should they pay?
Yeah, and maybe they don't necessarily need to all be under one flag, is what you're saying.
It's hard to do it under one monetary policy and 17 different flags.
All right, our own Sarah Eisen spoke with Mario, and I'm bad with names, but I believe his name was Mario Baldessari. He is an Italian Senate Finance Committee chairman. Listen up to this.
They try to float over the waves, hoping that sometime in the future, world situation will improve, European situation will improve, and Italy will be led out of the crisis by the outside conditions.
I hear a lot of hope in that. What do you hear?
More hope than substance. And part of the problem that we have today is that the size of the problem isn't small and isolated. A country like Sweden had issues some years ago and was able to fix them, but partly because they were small in relation to the world economy. Europe is not small in relation to the world economy, and for that matter, Italy is not small. So the idea that we can kind of hopefully ride across the waves, I think isn't going to be the solution.
Take us inside BlackRock, largest money manager in the world.
Yes.
It's Tuesday morning. I don't know if it's 6:30 or 7:30 or 7:45 or whatever it is, but you sit down in the conference room. Explain the process and what happens when you guys all get around the table.
Well, sure. BlackRock has a morning meeting 4 out of 5 days a week, and we conduct it by video conference really all around the world. It's anchored in different places, New York, London, to name two. And we go through what the markets are doing and what portfolio managers are doing and how we're seeing the world and different positions that we're making. And then immediately following that, my team has a huddle, and we talk about what we're doing and how we're seeing the world.
Now, you can put money just about anywhere. I think you're 46% in the U.S., you're 22% in Asia, 14% EU, et cetera, et cetera. Talk to me about some of the sectors you like.
Okay. Well, in this case, we're talking about BlackRock Global Allocation Fund. And we're stocks, bonds, and cash equivalents worldwide. We're very diversified. And we change that asset mix around over time to emphasize where we see the best opportunities in the markets. And today, in very general terms, equities look like by far a superior investment compared to bonds. We don't see much value in the Treasury bond market, to say the least. So we're overvalued stock, overweight stock, underweight bonds, and we have a little bit of cash to balance the risk.
All right, talk to me about sectors. I know you like energy. I know you like healthcare. Start with healthcare.
Well, in healthcare, we see very good value, low price to earnings ratios, high cash flow, good dividends, and stable earnings in the face of a tough economy. Now, in energy, we see exposure to growing world markets. Every day in China, approximately another 50,000 cars are on the road. It's 350,000 cars a week, about 1.6 million
new cars.
a month. New cars.
350,000 new cars in China every week.
Correct.
And they need oil.
They sure do. There's going to be a big ramp up in gasoline consumption, and that's going to be good for owners of existing reserves of energy.
Financials. I know you've not been keen on financials, but you said you've started nibbling. Where are you nibbling?
Sure. We have been very negative on the financial sector for over 5 years for the obvious reasons. And now there's been enough change and prices have been low enough that we've been nibbling at some of the U.S. financials, the big obvious investment banks and banks, but only when the market is very weak. And it's on a price basis.
And does the U.S. offer better value right now than either Asia or Europe?
In financials, we think that the U.S. offers a better combination of value and safety. Remember, we recapitalized our banks. Europe didn't, really. But if we're talking about more generally stock markets, we see things to like in both the U.S., Europe, and Asia, especially in Japan.
All right, Dennis Stattman of BlackRock. You manage $83 billion. I hope we can have you come back again.